Financial documents explained. In this video, we're going to look at the different types of financial documents that an organisation may produce and what do those financial documents actually mean. This video is going to look at the following documents: a purchase order, a delivery note, a goods received note, an invoice, a receipt, a credit note and a statement of account. To understand these, let's look at the process in action in a business. So B wants to order some paper from their supplier. So to do this order, B needs to raise what's called a purchase order. Now the purchase order is basically an order form that's saying what they want to order from the supplier. So they complete the details of how much paper they want to order, what paper they want to order, and they send it off to the supplier. The supplier will take that order and of course they will deliver the order. So as you can see there, the supplier brings the paper to B, and along with the paper delivery they will give B a piece of paper which will be called the delivery note. And the delivery note is the ability for B to check off everything that's been delivered. Basically, delivery note is what it says it is. It's all the items that have been delivered in the order. At this point now, B will check off, using the delivery note, everything that's been delivered, and then they will send back basically what's called a goods received note. Now the goods received note is telling the supplier exactly what B actually received. So your delivery note said that this should be in delivery. B's now checked it off and they're saying this is what I've actually received, and that gets sent back by B to the supplier. Once everything's complete and they've checked that off, the supplier will now send B an invoice. Now an invoice is basically a document that says to B, you need to pay us this amount of money by this date. So it's now saying you've had your order, you've checked your order off, we now want payment. And at this point here they send an invoice. So an invoice is asking for payment. Now of course once B has actually had the invoice and chosen to pay the invoice, the supplier will give B a receipt. And just like you see in the shop, a receipt is basically proof that you actually made that payment. It could be used in the future of course to help you if you had any claims because something was faulty, for example. However, it's a good financial document for your records to show how much you paid. So then of course B might say, for example, they found that some of the paper was faulty and it wasn't as expected. So they ring up the supplier and the supplier says to send it back. At this point now B would want a refund. So what the supplier would do typically is issue a credit note. Now a credit note is basically a document or a piece of paper or an agreement in your account to say you can have that money back and it'll rest in your account until you place your order next time. And then we will knock that amount of money off your next order. So effectively it's giving you credit. So imagine for example that I got a refund of £50. That means on my next order they would take £50 off because I have a £50 credit note. So a credit note is a document that basically gives you the ability to get a reduction on your next order because you've obviously sent something back or there's been an issue with some form of item that you purchased. And then finally we have what's called a statement of account. Now this is basically a document that lists all the transactions between B and the supplier. So it would show all the different invoices that have been sent to B, it would show all the different payments that have been made by B, it would show any credit notes that have been received by B, and it will show basically how much credit he might have on his account or how much he still owes his supplier. Now that document is typically held by the supplier and will be sent to B when they request it. So let's do a little quick recap of the process in action. So the buyer will obviously place their order, and to do that they have to raise a purchase order which then gets sent to the seller. The seller processes that order and then with the order they send they attach a delivery note. So the delivery note goes with the order to the buyer receives the delivery and they use the delivery note to check off the order, and then they would send a goods received note telling the seller all the items they actually received. At that point there, the seller would then raise an invoice. So the invoice is asking the buyer to make a payment. Of course the buyer would then make the payment and then would receive from the seller a receipt saying you are paid this amount of money. Now maybe the buyer was to find there was an issue with one of their items. If that was the case, then they would ask the seller to obviously issue a refund. They would do this by issuing a credit note. And of course, the buyer could ask the seller, or the supplier in this case, to supply a statement of account showing all the amounts of money that maybe they owe or maybe they're entitled to because of the different transactions that they've undertaken with the organisation. So we've now covered the concept in theory, but let's have a look at what it looks like in practice when we add some numbers. So that is what a typical purchase order would look like. So you can see that you would obviously have your supplier that you want to order from in the top left hand corner, and you'd obviously list the person who's ordering it. Now what you can see here is you have an item code and obviously an item name. The unit price is the price for each item, and as you see there, you've got the quantity. So if you order 2 of an item, then you have to multiply it. And you'll also see in this case here, you've got columns which are pounds and pence. So you have to work the item out in obviously how many pounds in one column and how many pence in the other. So to see the example there, 2 times 5 is 10, so it's 10 whole pounds, no pence. In the second one, it's obviously 5 times 2, so £2, which is £10 again, so it's 10 whole pounds, no pence. And obviously the spoon is just 50 pence, so 0.50 times by 1 means there's no pounds, 50 pence. The subtotal is literally what you've got added together above, and then you get a discount. And in this case here, we've got a 10% discount. So you can see there that there's a £2 and 5 pence discount. There's also £5 worth of carriage that needs to be added, or delivery. So you can see that £5 being added. Now, the way the total is calculated, if you're not sure, is that you obviously have to add your subtotal and your carriage together, which obviously would give you £25 and 50 pence. And then you need to deduct the discount, because remember, the discount is what you're being given. So you need to take away that discount. So at that point there, you can see that when we take it away, we get £23 and 45 pence. So that'll be the amount we actually have to pay. And that is sent to the supplier. The supplier takes that, and obviously they process your order, and then they would send you a delivery note. Now the delivery note is quite basic. It literally says who the supplier is, where they're delivering it to, and they don't put the prices on there. What they do is they put how many items or the quantity of the items you should find. So that helps you to check off the order. And it may state something like, please report any damages in 48 hours delivery, for example, whatever the terms are going to be. Now, the goods received note will literally be something quite simple. It could either be an email, so it'd probably be something saying literally what we received. It may look something like that. It may have the title at the top, but it could be something saying we received these items on this date and how many have we got. And that is literally the point where that process for the delivery stops. Because now an invoice needs to be raised by the supplier. Now the invoice will look something like this. It typically has an invoice number and it'll be dated. Again, it'll say who the supplier is and who the customer is. And you've seen it before. It looks very much like the actual purchase order. Only this time it's being sent by the supplier to the customer. And it will state what are the payment terms. So you can see there it says within 30 days. And again, the same process has been applied. As you can see, the discount's been taken off and obviously carriage has been added on. So that's what they're being billed for. That's what the invoice looks like. Now, a receipt is fairly straightforward, and I don't think we need to cover that because I think you've all seen what a receipt looks like. However, the next item you could see is a credit note. Now, this could be a case, let's imagine that B has phoned up and they complained that the quality of the spoon wasn't good enough. So a credit note, again, would have a number attached to it, it'd have a date attached to it, and it'd say what items are being credited. So in this case here, the spoon is being refunded, and you can see here, they're saying that the spoon was 50 pence, that you had one of those items that's faulty, so they're giving you a refund, basically, or a credit note of 50 pence. Now remember, that would then go on to the statement of account. And that is what a statement of account would look like. So I've tried to create this so you can see the numbers and where they come from. So again, you have things like August balance. So in other words, what was the balance of this account in August? In other words, it was zero. It settled up. There was no outstanding money. So B had paid the supplier. There was no credit notes, obviously, in the favour of B. Now what you can see here is that on August the 12th, invoice 1 was for £400. And as you see there, the amount due on that account was £400. It was a sale. So B ordered basically £400 worth of honey from the supplier. Now B made a payment on August the 30th as a receipt, so you can see the payment there. So a payment was made of £400, and obviously the account balance now is zero. You can see there, so the amount due is zero. So at this point here, everything's cleared off, as you can see. The end of the balance is there. Now we come to September, and invoice 2, the one we've just been looking at, has just been made. So you can see there's a sale of £23.45. And that now means B now owes £23.45. Of course, we've just seen already, there's now been a credit note issue because B's made a complaint regarding the quality of the spoon. So you can see there that now this is why it's a negative, because remember, this case here, this is from the supplier. So B is entitled to a discount of 50p. So suppliers are basically saying there, they've given a credit note of minus 0.50. In other words, a discount of 50p. And now it says the amount due on the balance is £22.95. At this current point, you can see there is no receipt there at the moment. There's no payment being made by B. But when B does make the payment, you would expect B to make a payment of £22.95, because that then would clear the account back to zero. If B was to overpay that, then obviously the opening balance would be in B's favour. It'd be in credit, for example. But that's what the statement account looks like. So hopefully that explains the process of financial documents. Yes, it's going to be quite a complex area to get your head around at first. However, these terms should hopefully become fairly logical when you follow through the process. If you need additional help, I have more videos on this topic and more resources. However, hopefully that has enabled you to understand this concept and make you feeling confident that you could take these skills into the wider world and into any exams that you're about to sit. Don't forget to follow me on YouTube, click the subscribe button, and also make sure you have a look at some of my other videos. Until next time, everybody, keep buzzing.